Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Futures Contracts Investment Explained: How they work and why they matter guide. In this video, we continue by examining strategies, risks, and practical tips for trading futures successfully. There are two main types of margin you should know. Initial margin. This is the amount of money you must deposit in your brokerage account before you can open a new futures position. It is generally a percentage of the total contract value, but it is not a down payment on the asset itself. Think of it as collateral that demonstrates your ability to honor your contract. The exchange or clearinghouse sets initial margin requirements based on the volatility of the underlying asset. Maintenance margin. Once you have an open position, your account balance must stay above a certain level, known as the maintenance margin. This level is typically lower than the initial margin. The market value of your futures contract changes daily, reflecting profits or losses. If your account equity falls below the maintenance margin level because of unfavorable price movements, a margin call occurs. A margin call is a demand from your broker to deposit additional funds into your account to bring it back up to the initial margin level. If you receive a margin call, you must deposit the required funds promptly, often within 24 hours. Failing to meet a margin call can lead to your broker automatically closing out your position. This means your contract is sold or bought to cover the deficit, which can lock in losses. Margin calls highlight the importance of active risk management when trading futures. Why trade futures? Hedging versus speculation. People trade futures for two main reasons: managing risk or aiming for profit. These two approaches, hedging and speculation, involve different goals and strategies. Understanding the difference helps you see the broad appeal of futures contracts. Using futures for risk management, hedging strategies. Think of hedging as insurance for future prices. Producers and consumers use futures contracts to lock in a price today for a transaction that will happen later. This helps them avoid the uncertainty of market price swings. Consider a few real-world examples. For producers, an oil producer knows they will have 10,000 barrels of crude oil to sell in 3 months. They are worried the price of oil might fall by then, cutting into their profits. To protect themselves, they can sell oil futures contracts today. This locks in a selling price for their oil. If oil prices drop, the loss on their physical oil sale is offset by the profit from their futures position. For consumers, a large airline knows it will need millions of gallons of jet fuel in 6 months. They are concerned that fuel prices could rise, increasing their operating costs. To manage this risk, the airline can buy jet fuel futures contracts now. This locks in a purchase price. If fuel prices go up, the higher cost of buying physical fuel is balanced by the profit from their futures contracts. In both cases, the goal is not to make money from the futures contract itself, but to reduce financial risk. Hedging provides stability, allowing businesses to plan and budget with more certainty. Profiting from price movements. Speculative trading with futures. Speculation is about predicting market movements and aiming to profit from them. Speculators use futures to bet on prices going up or down. They do not intend to buy or sell the actual underlying asset. Their goal is simply to profit from the price difference of the contract itself. Here's how it works. Betting on price increases. If a trader believes the S&P 500 index will rise, they might buy an S&P 500 futures contract. If the index does increase, the value of their futures contract goes up. They can then sell the contract for a profit before its expiration. Betting on price decreases. If a trader thinks the price of gold will fall, they might sell gold futures contracts. If gold prices drop, the value of their short futures position increases. They can then buy back the contract at a lower price, making a profit. This is similar to selling high and buying low. A key concept in speculative futures trading is leverage. This means a small amount of money, your margin, controls a much larger value of the underlying asset. For example, with just a few $1,000s in margin, you might control a futures contract worth tens or even hundreds of thousands of dollars. While leverage can amplify profits, it also magnifies losses. A small price movement against your position can lead to significant losses, potentially more than your initial margin deposit. This is why speculative futures trading carries a high level of risk and is not suitable for everyone. It requires careful research, strategic thinking, and a strong understanding of market dynamics. Diverse markets. Types of futures contracts available. Futures contracts are incredibly versatile. They let you gain exposure to a huge variety of assets without actually owning them outright. From raw materials that power our world to financial instruments that track economies, there is likely a futures contract for almost any market you are interested in. Commodity futures. Energy, metals, and agriculture. Commodity futures deal with physical goods. These are the building blocks of our economy and they play a big role in everyday life. Trading in these futures often involves speculating on supply and demand shifts. Here are some of the most common types. Energy. Think about how much energy we use daily. Crude oil WTI and Brent. These are perhaps the most well-known energy futures. West Texas Intermediate WTI and Brent crude are benchmarks for global oil prices. Companies like airlines and shipping firms use oil futures to hedge against rising fuel costs, while speculators bet on geopolitical events impacting supply. Natural gas. Often used for heating and electricity generation, natural gas futures are highly sensitive to weather patterns and storage levels. Utility companies are major hedgers in this space, securing future supply and pricing. Metals. Metals futures are popular for their industrial uses and their role as safe haven assets. Gold. Gold futures are widely traded, often seen as a safe investment during economic uncertainty. Jewelers might buy gold futures to lock in prices for future production, and investors might use them to speculate on inflation. Silver. Silver has both industrial and investment demand, making its futures contracts dynamic. It is used in electronics and solar panels, so industrial demand heavily influences its price. Agricultural products. These are essential for our food supply and can be volatile due to weather. Corn and wheat. These grains are fundamental food sources and livestock feed. Farmers often sell corn or wheat futures to lock in a price for their upcoming harvest, protecting against price drops. Food manufacturers might buy futures to ensure stable ingredient costs. Financial futures. Interest rates, currencies, and stock indices. Financial futures are agreements based on financial assets rather than physical goods. They are a go-to for investors and institutions looking to manage risk or profit from movements in major financial markets. Let's look at some key categories. Interest rate futures. These contracts are based on interest-bearing debt instruments. They are crucial for banks and investors managing exposure to changing interest rates. Treasury bonds. Futures on U.S. Treasury bonds and notes allow traders to speculate on or hedge against changes in interest rates set by central banks. If you believe interest rates will fall, you might buy Treasury bond futures, expecting their price to rise. Currency futures. These allow you to agree to exchange one currency for another at a fixed rate on a future date. They are useful for international businesses and currency traders. Euro USD Euro US dollar. Trading Euro USD futures means you are betting on the exchange rate between the euro and the US dollar. An exporter expecting to receive euros in 3 months could sell Euro USD futures to lock in a favorable exchange rate today. Stock index futures. These contracts are based on the value of a stock market index, like the S&P 500. They give you broad exposure to the stock market without buying individual stocks. S&P 500 futures. These are among the most liquid financial futures. Investors use them to speculate on the overall direction of the U.S. stock market or to hedge a diversified stock portfolio. For example, a fund manager with a large stock portfolio might sell S&P 500 futures to protect against a short-term market downturn without selling all their individual stocks. Futures contracts are fundamental to global finance, offering powerful tools for risk management and market participation. They allow businesses to stabilize costs and revenues, while providing opportunities for investors to capitalize on price changes across diverse markets. From oil to interest rates, these standardized agreements, backed by robust clearinghouses and margin systems, connect today's decisions with tomorrow's values. As markets continue to shift, futures will remain essential for those looking to manage uncertainty and pursue strategic financial goals. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.